All right, welcome to The Explainer. Today, we're diving into a book that pretty much turned personal finance on its head, John C. Bogle's The Little Book of Common Sense Investing. The core idea is almost too simple. What if the easiest way to invest is also the best way? It all kicks off with one really provocative question.
So here it is. This is the idea the entire book is built on. What if the game you're probably playing, the one where you're trying to outsmart the market, what if that's just a loser's game? Like you're set up to fail from the start? Bogle's answer is a big, flashing yes, and he proves it with some super simple math and a great little story.
And that proof, it starts right here. It's a simple little story, a parable really. Bogle uses it to take this huge, complicated idea about the stock market and just make it click.
Okay, so picture this. There's this family, the Gotrocks, and they literally own everything. Every single stock in the entire U.S. market. They own the whole pie. So every year, as businesses grow and pay out dividends, they all get richer together. Simple, right? But then these helpers show up, and they start whispering to some of the cousins, hey, we can get you a bigger slice of that pie than everyone else. So what happens? The cousins start trading stocks back and forth with each other. And every single time they do, the helpers take a little fee for their help.
Now, here's the kicker. The family is just trading with itself, right? They're not creating any new wealth. In fact, their total pile of money is actually getting smaller. And it takes a wise old uncle to finally say it out loud, hey, all that money you're paying the helpers, it's coming straight out of our family's pie. They were literally paying to lose a game against themselves.
And that little story, that's the perfect setup for Bogle's big point about how investing works in the real world. He calls it the loser's game, and it's all based on something he calls the relentless rules of humble arithmetic.
So according to Bogle, there are really only two games you can play. First, there's the winner's game. That's super simple. Just own a piece of all the businesses out there, the whole market, and enjoy the rewards as they grow. But the second you try to get clever and beat the market by picking and choosing, well, you've just stepped into the loser's game. Why? Because now you've got costs. Those helpers from the story are real, and they take their cut, which mathematically guarantees that investors as a whole have to lag behind the market.
And we are not talking about chump change here. These costs are real. You add up all the management fees, maybe some sales charges, and then the really sneaky ones, the cost from all the buying and selling the fund does. Bogle figures the total drag can be around 3% every single year. Now you might think, 3%, what's the big deal? Well, hold on, because over a lifetime of investing, that tiny number it's just devastating.
Just look at this. This is what that cost drag does over time. Let's say you invest $10,000 and leave it for 50 years. If you just got the market's return, we'll call it 8%, you'd end up with almost $500,000. Pretty great. But if you're paying those costs, say 2.5%, look what happens. Your final pot is just $145,000. Those costs didn't just take a little off the top. They ate most of your future money. It's wild.
Okay, let's look at that same pile of money a different way. Over those 50 years, who got the biggest piece of the pie? It wasn't you. The financial middlemen, our helpers, walked away with almost 70% of all the money the market generated. You, the person who put up all the cash and took all the risk, you got to keep less than a third of the profits. It's insane, right? Bogle calls this the tyranny of compounding costs, and it's exactly why the loser's game is almost impossible to win.
Okay, I can hear you thinking it right now. Right, I get it. The average fund is a bad deal. But I'm not going to pick an average fund. I'll just find the rock star managers, the ones who always win.
And look, that's the #1 pushback to this whole idea. It sounds perfectly logical, doesn't it? Just pick the winners. Simple. The only problem is that the actual data, the hard numbers, show that this strategy is a total trap. Check out this data. It tells such a crazy story. These funds here, they were the heroes of the dot-com bubble, the absolute top performers. People were throwing money at them. But look what happened in the very next 3-year period. Every single one of them went from hero to zero, plummeting to the absolute bottom of the performance charts. The 9th best fund became the literal worst. It's a classic pattern called reversion to the mean, and it proves that chasing hot performance is a surefire way to get burnt.
So trying to find that one magic fund manager who can do it year after year, It really is like trying to find a needle in a haystack. Which leads us to Bogle's brilliantly simple solution wrapped up in his most famous saying. Don't look for the needle in the haystack, just buy the whole haystack. And that right there, that's the common sense solution this whole book is about. So, if trying to beat the market is a loser's game and trying to pick the winners is a fool's errand, what are you supposed to do? Well, you buy the haystack. So buying the haystack just means owning a simple, low-cost index fund. Instead of trying to find the winning needles, you just own all of them. And when you put it side by side with a typical active fund, the difference is just night and day. The index fund gives you the whole market. The costs are tiny, there's almost no trading, so it's tax efficient. The active fund, it's a concentrated bet with high costs, tons of trading, and it's super inefficient with your taxes. I mean, the advantage for the index fund is just massive.
And hey, don't just take Bogle's word for it. Listen to this. This quote is from the late David Swensen. This guy was a legend. He ran Yale University's multi-billion-dollar endowment with incredible success. And he said that a whopping 96% of funds fail to beat a simple index fund. And here's the key part. They don't just lose by a little bit. They lose by a wealth-destroying margin. When one of the smartest investors on the planet says that, you should probably listen.
So, what's the bottom line here? How do you actually use this information? Bogle lays out a really practical, common-sense way to structure your own investing.
He says to think about your money in two different buckets. First, you've got your serious money. This is the big one. This is for retirement, for your family's future, the really important stuff. And that money goes into low-cost index funds. And the strategy is simple. Don't touch it, stay the course. But then, he says, have a second, much smaller bucket for your funny money. You know, if you get that itch to gamble a little, to try and pick the next big thing, do it with this money. Have fun. But, and this is a big but, only use a tiny amount and be totally okay with the idea that you might lose every penny.
So how much goes in that serious money bucket? Bogle's recommendation is clear. At least 95%. See, this isn't about taking all the fun out of investing. It's about being smart. It's about protecting the overwhelming majority of your life savings from those relentless rules of humble arithmetic and making sure you don't get suckered into playing the loser's game.
Let's end on this one final thought, and it's a bombshell. It's from the Nobel Prize-winning economist Paul Samuelson. He said that the creation of the first index fund was as important as the invention of the wheel and the alphabet. I mean, think about that. The wheel, the alphabet, and the index fund. That sounds crazy, but it gets to the heart of it. This simple idea is that powerful. It guarantees that you get your fair share of whatever the market gives. And in a world filled with those costly helpers, all trying to take a slice of your pie, getting your fair share isn't just good enough. It's how you win.